Awesome. Well, let's go ahead and get started. All right, folks, welcome back to another Rev Real Estate Live. Appreciate you joining us. I recognize just about all of you, so appreciate you coming back. It means that we're giving of something of value, so appreciate you being here. My name is Dallin Schultz. I'm the president of Rev Equity Group. We focus on acquiring large apartment and acquisitions in real estate and partner with people in order to take those down. And we do these weekly webinars not to solicit any deals, but what we found is that the most educated investors become the best investors. Whether you're looking to do this actively or passively, you've got to understand what goes on behind the scenes. So what we do on these weekly webinars is we pull the curtain back and we invite you into our lives and show you the processes that we go through to vet deals, to vet operators, and to really educate people on the powerful tool of multifamily investing. So we often bring in guest speakers to speak on different aspects of the business. And today we have just that. So I'm super excited to welcome our guest, Justin Jensen. He is a CPA, and I'll have him introduce himself a little bit more and give some more background. He specializes in real estate. And I'm telling you, if you're not currently invested in real estate and you're in this transition, absolutely 100% make sure you get a CPA that knows real estate, because it is such a wide area of the tax code, and your typical $500 a year CPA that just plug and chugs to do your tax return isn't going to know what they need to know to maximize and mitigate your tax liability. So make sure you get with a good CPA. And what we're going to focus on today is Justin is a CPA that focuses on real estate, but also invests in real estate. So he has a very unique perspective to show how, even if you're not considered a real estate professional, how you could still maximize the benefits of investing in real estate. So without further ado, Justin, I'll go ahead and turn the time over to you. And if you wouldn't mind, just take it a couple minutes and introduce yourself, share a little bit about your background, and then we can go ahead and get right into it.
Yeah, sure. I'd be happy to. And thanks for having me again. I've really been enjoying getting to know you and Paul and Jim, and appreciate the opportunity to work with you and come back. Mostly because I just have so much to say, and I don't know how much time we have, but I'll try and keep it just as brief as possible. But and can you hear me okay, Dallin?
Yep, you're coming in good.
Okay, great. So as Dallin mentioned, been a CPA for over 20 years, and it's just interesting how things happened. I was in graduate school, and I already had a job lined up with PricewaterhouseCoopers in Seattle. I went to school at Utah State University in Logan, Utah, and while I was there, I just wanted some experience. I ended up getting an internship with a real estate investment firm. And all I did was prepare tax returns for that 1 year. And I really thought that's as cool as it got. When I got, and I felt like I couldn't even go up from there almost, but got to Seattle, and they felt like because I was already working in real estate, I should just stay working in real estate, started doing cost segregation, development deals, all kinds of real estate related tax clients. And from there, it just snowballed. 4 years later, I went back to that same company I had interned with as their tax director, prepared 400 tax returns. I had a team. I didn't prepare them all, trust me, but I had a team and we all prepared about 400 tax returns. We handled all the K-1 reporting. I missed public accounting, and the core group of investors that made up most of the equity there at that firm said to me, "You're preparing with all the K1s that we were preparing, that I was handling 85 to 90% of their tax return." And then they approached me and said, "Why don't you just do the rest of it?" So I said, "Sure, that sounds great." I went into practice on my own, and then just like had this instant real estate base of clients, and it has just continued to snowball and evolve from there. Shortly after that, I ended up relocating to Arizona, met Tom Wheelwright, and brought my real estate book of business with me, and then been in Arizona now for 12 years, and 5 years with Tom, but every move has been taking my real estate book of business with me and building upon that. And then as Dallin was saying, when I worked for that firm, I was in a unique position where I was able to invest in, even as a non-accredited investor, because I was involved firsthand with the information, analyzing the numbers. I was allowed to participate in some of those deals, and even through carried interest. So that's what started me on my real estate path. But it's been now 20 years. So anyway, if anybody has any other questions about that, let me know. But I love talking about real estate, and I could really, really get tangenting into one thing. So Dallin asked me to talk about the tax advantages of investing in real estate. And there are just volumes and volumes, or there's volumes and volumes of material that you could read on this topic. So I just kind of narrowed it down to one thing. But I like to tell people why I think that, and maybe some of you have seen this before, why I think that real estate is an ideal investment. And we can go as deep into this as you might like. Hopefully you can see that. I didn't go too low. But it's an ideal investment because of the income producing characteristics that it has. Generates a lot of income, and it's passive income, and there's tax benefits to having that type of income. It's not earned income. It's not subject to self-employment taxes or payroll taxes. We can get into real estate using debt. We don't have to use our own money. We can use other people's money. And having worked with Tom Wheelwright and being affiliated with Rich Dad Poor Dad and Robert Kiyosaki, was a huge fan of the concept of other people's money. Another reason that real estate makes such a good investment is because of the equity. And this can mean a few different things. This could mean like the pay down of principal. It can mean the organic equity that's created as the property that you purchase continues to go up in value, which is the next one here. We'll say appreciation. And that's one of the things I think it has an advantage over, say, investing in the stock market. Obviously, you want to buy low and sell high in the stock market, but with real estate, you have a little bit more control because you have forced appreciation. You can make the improvements. You can do the things to increase the value of the property, to increase your equity. And then here again, it's this kind of all relates to each other, but the L being leverage. And so these are some of the things where I think, and to be cheesy that way, that real estate makes an ideal investment just because of all of these characteristics. But the one thing that really kind of overarches everything, and I definitely want to go into more depth on, for tax purposes, you've got the debt. I want to talk about that, and I want to talk about the leverage. This is kind of where the tax benefits come in and make it a much more appealing investment. And I'm just gonna start over here a little bit with some stuff. But basically, I want to talk about depreciation. Here we talked about appreciation, which is not the opposite of depreciation. Depreciation for tax purposes is really advantageous because it's a non-cash deduction. I don't have to pay for it. I don't have to write a check to take a deduction for depreciation. And in the meantime, I think that's getting smaller as I go. In the meantime, the property that we buy using leverage with other people's money is generating income, and the IRS is allowing me to take a deduction for it on an annual basis. So what other investment can do that? Certainly nothing in the stock market, but certainly nothing in the stock market. But that's seriously, in a nutshell, why I like real estate. I tell the story a lot. When I worked for the real estate company in Utah, the founder of that company was worth quite a bit. The last year I worked for him, it was north of 500 million, and it's definitely gone up from there. But I remember having lunch with him one day. He used to insist that I personally work on his tax return, and it would take me 2 solid weeks, 300, 400 K1s, making sure everything else was balancing out, and even just the tax strategy, working on that kind of stuff with him. But I finished his tax return. This would have been in 2007. Finished his tax return, and we went to lunch to talk about it. Went through everything, and he just was happy with the outcome and was really proud. And at the end of the conversation, he says to me, "Not bad for a farm boy from Utah who started with nothing." And this is where investing in real estate really started to click for me, because I thought, started with nothing, and he talked me through other people's money and leverage and the tax benefits. And the one thing that he absolutely loved about investing in real estate was depreciation, because depreciation gives the tax benefits. But I also tell the story kind of as an afterthought to that story, that he told me that when he first got started in real estate and realized he could start making money at it, that his goal was to have $20,000 a month of positive cash flow. And I was dumbfounded, like 20,000 a month. He had made $30 million that year. And like $20,000, that's, he could see that look of bewilderment on my face. And he said, "Oh, how I set my sights low." But, as you go into it, that was huge for him. That was his goal. That was his plan. But it started to gain so much momentum and just snowball, just one thing after another. It's almost like he couldn't stop. And so that's the other reason I like real estate as an investment. But certainly as a tax geek, I like the tax benefits that are associated with real estate as well. So if everybody is okay with it, I'd like to go through a little example on how that would work for us, because, and maybe you might remember from the last time that we met, I always use the the $1 million example, because it's a nice round number and it's easy to remember. But if you remember, if I start with $1 million and I acquire $1 million asset, I've got to do two things. I've got to allocate between the land and the building. Land, we'll say, is 200,000 or 20%, and the building then we'll say is 800,000 or 80%. So I think it was on the last call that we had that one of the callers, Jose Miller, had actually asked what the difference is in tax benefits if he bought the property totally in cash for $1 million, or with leverage, say for a $200,000 down payment. Either way, whether you finance the whole thing or you pay for the whole thing, you're still going to get this same type of allocation between the land and the building. But bear in mind that land actually has two parts to it. Land has, or actually, let's say there are 4 major parts of any real estate that you purchase, because there's land, and then there's land improvements, and then there's the building, obviously, and then there's the contents of the building. So the reason this becomes significant is because if I buy a building for $1 million and I allocate 200 to the land and 800 to the building, a lot of times people will stop there, and the CPAs will stop there and say, "Well, that will be about as good as it gets." And sometimes it's even a worse allocation. I see kind of 80-20 as a general rule of thumb, 80% towards the building, 20% towards the land. I've seen people take 60-40, and which I think is way too much to the land in most cases. And it really depends a lot on the location, obviously. But if we do nothing more than that, then that building will depreciate over 27 and a half years, we'll say residential rental property. So 27 and a half years gives me an annual deduction of roughly 29,000. It's 29,000 and change, but we'll keep it simple here.
And Justin, real quick, you touched on this, and I want to go a little deeper because a lot of people don't realize this. You mentioned a residential investment real estate, real estate. If you were to invest in commercial, what's the time frame on that?
That's much worse. It's 39 years, but it still has the same, this is for commercial. It still has the same benefit in that depreciation is a non-cash deduction, and you can still do some of the things I was just about to talk about, how we accelerate depreciation. Commercial properties do that too. So,
and the reason I wanted to bring that up is because if you are looking at these side by side and you're considering going into a commercial real estate or an apartment building, this is something to consider. How much depreciation you can take and how long you can spread it out for.
absolutely. And I'm definitely building up to all of that, because, when we say 27 and a half years, 39 years, that's your cost recovery. But that's the cost of the building, that it's going to take us 39 years if it's commercial, 27 if it's residential, to recover that cost. And and so you can do the math. 800,000 divided by 27 and a half is 29,000 and change. So basically, and this is the benefit of real estate with depreciation being a non-cash deduction. If I buy this property at $1 million and I allocate 800,000 to the building, I only have to come up 200,000 out of pocket to buy the building. My tenants are paying for the building, they're paying the mortgage, they're paying everything else, they're generating the cash flow to cover all the expenses, but I still got to take a $29,000 deduction. So if my cash flow for the year, and this is just a simplification, my cash flow for the year, or my income for the year rather, is $29,000, that's $29,000 of tax-free income, because my cash flow statement is not going to be reduced by $29,000, but my income statement is. And I don't mean to get too nerdy on the accounting kind of stuff, but the idea is that this $29,000 deduction shelters from tax $29,000 of taxable income. And Don, is that direction you want? Did you have some other point that you wanted to make, or a different direction?
No, I just wanted people to recognize that the 27 and a half years isn't for all real estate. Not all real estate's created equally. And what I just wanted to highlight why we love apartments at Rev is because you tap into the commercial aspect of real estate, meaning you can force the appreciation by increasing the income that property generates. It's a business. That's what you're buying. So not only do you tap into the benefits of the commercial real estate, but you can depreciate it in a shorter period of time, unlike other commercial real estate.
That's exactly right. And here I mentioned the gentleman I used to work for when I really started getting into real estate. He had a very large portfolio, and he had commercial real estate and residential real estate. And he used to say he had his bases covered. In good economic times, businesses were booming and people were buying houses. That meant that there wasn't as much going on the residential rental side. But he had commercial property, and businesses were using up his commercial property. But when the pendulum swung the other way and business was tight, and people were losing their houses or were not able to buy houses, then he owned residential real estate, and he was able to ride that side of the cycle as well. So, but Don, you make a good point. They depreciate differently, but they do both depreciate. That's the important thing to remember. So I want to give you a little bit of a breakdown here. Let's see what would be the best way to do this. Because if I do the land and building that we talked about before, and I only get that $29,000 depreciation deduction, remember the depreciation is non-cash. So that depreciation deduction shelters income. So the tax strategy here now is to accelerate that depreciation best I can, as much I can, so I can shelter more income and get more tax-free cash, essentially. So if I want to represent this kind of in a breakdown, just to show you how this all works. So I want to accelerate that depreciation. We'll do that through a cost aggregation study. Cost aggregation study says, rather than 200 in land, we'll probably stick with 200 in land because we can't get too aggressive there. So let's go 200 land. And then building is going to have other elements to it. It's going to have the contents of the building, and we'll include with that building or land improvements. That's landscaping. I look outside my office building here. There's covered parking. There's bollards that protect the meters and things that come through so that a car can't smash into it. Those types of things are land improvements. Land improvements depreciate over 15 years, The contents of the building will depreciate 5, 7, or 10, but we'll go with 5 in this example. So, but if I stack this up like this and I say 800 went towards the building, but I want to break it out now between the improvements and the contents. And that can be as much as 30%. And so typically it would go like this. If improvements, we'll say we're 10% of the 800,000. So now I'm at 80,000 here. And we'll say that the contents of the building were the other 20%. So 20% of that would be the 32,000. Hopefully everybody can see that, which leaves then the rest of the building is at 560. So I know we're being recorded, so hopefully this all works out, but that should be your $1 million right there. There's your whole allocation of your purchase price. Now this allocation is much more advantageous because rather than $1 million purchase with 200 to the land, which we can't depreciate, it doesn't wear out, there's no deduction for it, an $800,000 building, which gives me that $29,000 deduction every year, the improvements and the contents, these, in fact, let's do this. Let's say land does not depreciate, but improvements depreciate over 15 years. The building then, in this case, residential, 27.5 years, and the contents will say 5 or 7. There's actually 3 and 10 in addition to that, but typically in residential real estate, you're going to see a 5 and a 7. And examples of that would be, for example, the flooring. If you buy a building and it includes flooring and it includes other elements of the building that are not going to last 27.5 years, you're going to have to replace that. So if I segregate it out, I can dispose of it and maximize that depreciation. Also, because these are eligible for bonus depreciation, which we'll get into more detail later. But the point I wanted to really drive home is that if I deduct this 80,000 and 32,000, okay, we'll get into it now, because bonus depreciation for 2023, maybe most of you know, is no longer 100% and is now 80%. So I'm only going to be able to immediately write off 80% of this 80,000 and 80% of this 32,000. And so the way that shakes out, well, we'll write off those amounts. So that would be the 16,000 here and the, oh, I'm sorry, that totally doesn't add up. How embarrassing. Okay. We may have to go back and edit that. This should be 160. I'm so sorry, I was looking at the wrong column, because then I can bonus depreciate 20% of this, which is that 16,000. And I can bonus depreciate 20% of this, which is 32,000. And I wanted to point out that before, when we had a building at 800,000, we depreciated that over 27.5 years. That gave us a $29,000 deduction. But now our building is 560,000. Well, we're still going to depreciate that over 27.5 years. But now, rather than a $29,000 deduction, where did my notes go? That will give us 20,364. We'll just say 20,000, just to be, well, we'll say 20,000. We'll put the whole thing in there. It's 364. So we're still going to be able to depreciate that. So we'll get through the cost segregation to accelerate the deduction. We'll get 16,000 in bonus, $32,000 in bonus for these two categories, and we'll continue to depreciate the building. So what that means is, in the very first year of operation for this building, if I bought this building at a $200,000 down payment and I made these allocations in that very first year of operations, then what does that come to? That comes to,
Justin, real quick. I
yeah,
thought it was 80% we could get as bonus depreciation, correct?
you are so right. I am looking at the wrong column here.
So
I meant
I
to
think
say
that 16,000
this is
that's
my
the
remaining.
20% you can't depreciate.
Correct. No, you can depreciate. That's the point I was trying to make. And I'm so sorry. I totally misspoke. Because this should be the 560 is the building. I get to continue to depreciate. That'll lead to a $364,000 deduction. The land improvements, you're absolutely right. The 80% got bonus depreciated. So the remaining depreciable value then is the 16%, because I actually got to deduct the 80 before. So that's going to give me an annual deduction of $1,067. And then with the contents of the building, I'm going to bonus out the 80%. That's going to leave me with $32,000, which is going to give me rather an annual deduction of $6,400, essentially, or roughly. So this total is $27,831. So this is my annual depreciation just on the operations of the building. So this doesn't include the bonus on the front end. The bonus on the front end that I categorized into 15 and 5 and 7 on through the cost segregation, that's actually going to give me $192,000 deduction in year one. And so look at it like this: if I if I bought the building and I allocated 800 to the building through bonus depreciation, if I'm able to reclass 30% of that, 10% in the improvements, 20% in the contents, then that's a $240,000 deduction. But we don't get 100% bonus depreciation. We only get 80%. So that's the 192. Is 80% of the 240,000, which would be the 30% reclass from 800,000. So in year one, my total depreciation is 219,831. So what that tells me is even though bonus depreciation has been reduced from 100% to 80%, a $200,000 investment in a $1 million property in year one is going to give me almost a $220,000 deduction. So it still makes a lot of sense to try and generate as much or accelerate as much of that depreciation as you possibly can. And Dallin, thank you. I really got sidetracked there. I was looking at the wrong columns here. I write too small, but thanks for bringing me back in. You're absolutely right. And I know you like to normally save questions to the very end, but especially with the sidetrack there, if I've just caused everybody to see sideways and have questions, I would happily take any questions now if there's any.
There is one in the chat box that we can start with, Justin. So this is from Robert Clyde. He lives in the Myrtle Beach area. He just moved there. And he says what he sees in the Myrtle Beach land is high. So what's the benefit from changing that formula to like 60-40? And I'm assuming that's 60 to the building, 40 to the land. Because you will see that in situations in coastal towns, especially in like California.
Absolutely. And I mentioned that a lot of that's going to be largely depend on the location. Because what are you buying? You're buying the land. If you're on the beach or close to, you're buying the location. So if the question is what's the benefit of 60-40, there's less benefit, but there's still benefit because you're still going to do this same drill where you're going to do a cost segregation and accelerate as much of it as you possibly can. So in those situations, what I would recommend, absolutely do a cost segregation, because if you don't do a cost segregation, then if you buy $1 million property on the beach, then you're going to have a $400,000 plot and a $600,000 building. So then from that 600,000, before I was mentioning 30%, I would push that as high as you possibly could. And understand that pigs get fat and hogs get slaughtered. That doesn't mean you can say, well, I'll take and say that 80% of the contents of the building were in these 15 and 5-7 year categories. That won't fly. But you could probably get as high as 30 or 35% in those scenarios. So, I would be as aggressive as you dare to be in a cost segregation, but I would absolutely do cost segregation in that scenario. So hopefully that answers this question. Or
Robert, did that answer your question all right?
yeah,
Yes, absolutely. That helped out a lot. I just was trying to figure that out because what
Oh,
I'm
okay.
seeing here is there's not a lot of cash flow left on these properties, but because of the price of the land, they're all beachfront or within a half a mile is where
Yeah.
I'm seeing the money being made, and that's what I was trying to figure out.
So that's actually a good point, because here we talked about stock market buy low, sell high. When you talk about locations that have a high land value, then clearly we want to get the best deal that we can. We want to buy as low as we can. That's not always going to be possible. It's very competitive. It's in high demand. It's an ideal location. It's not going to be for a discount, or if it is, you find those properties. But the idea here is that, when you get into real estate investing, it's worth your while on the front end to develop that strategy, to say, I'm going to invest in these markets and these are the properties I'm going to identify. So you've done all the homework on the front end, and you spent the time on the front end evaluating the properties so that you know exactly what your criteria is. So that when the property comes your way, rather than spending hours and hours looking at each individual property, it's like a 5-minute decision. It's like, nope, this one does not meet my criteria, I will pass. And if you find that you're passing time and time again, you just continue to pass, it might be time to refine your criteria, a little bit, and say, well, maybe I'm too stringent on the location, or I'm too stringent on the price, and just refine that. But the idea is that then, and I was going to get into that after I talked about the depreciation. We want to accelerate depreciation that shelters a lot of income. But let's not make an investment based on tax benefits. I sometimes say, and I'm a nerdy tax guy, but I still don't like to see the world through tax colored lenses. We've got to make good investment decisions. It's got to make a good return for us, and then we can worry about how to shelter the taxes on, later on. But as long as you're able to get into their property, improve the performance, get that forced appreciation, increase the value. Because remember, I had the ideal list. You can affect the appreciation. You can affect some of those points that I had made. You're in control. And if you can drive that up and drive it up, that appreciation, then even if it's on the beach and you didn't get to take the depreciation deduction, still a good investment. And just kind of as a tangent to that, I do have clients in California who have run into this issue. They've got very highly desirable properties because of their location and vicinity to oceanfront. And just kind of in general, just as a side note, they have a 2-part strategy. They have their high value property that they buy, and they have that criteria where they're buying the properties in California. They're buying properties in other states too to generate some of this deductions, because these deductions lead to passive losses. The other income that's made on the higher end come from, or generate passive income. The passive loss offsets the passive income, and they're still able to pay little to no tax. So you just have to broaden your strategy to maybe more than just the one location. So, and I didn't mean to tangent too much, but Robert, does that answer your question? Does that help a little?
Yeah, absolutely helps out a real lot. Greatly appreciate it.
Great. Sorry for the rambling.
The important thing here too is, again, the tax code, this tax information can be very complex and very overwhelming. So the purpose of having these webinars is to introduce you to the ideas. And I had to read and learn and listen about depreciation over and over and over again before I started like finally understanding, okay, that's what it can lead to. So if this is a little overwhelming, it's okay. Like if this is your first time hearing about it, really learning about it, it's okay. But at least now you're aware, because now that you're aware of it, next time you hear about it, next time somebody talks about it, you're going to start picking up on it and understanding it. So there is a lot of information here that Justin already discussed. Do we have any other questions regarding the bonus depreciation and how these numbers shake out?
Yeah, I just wanted to know kind of the implications of that depreciation on W-2 income.
Great question. It's like you're reading my script or something. But in fact, let me build into that. The quick answer to your question is that it depends. Obviously, that's always the CPA and attorney's favorite answers. It depends. But passive income and loss from real estate is passive by definition, by nature. Per the Internal Revenue Code, it is defined as being passive. Your income from your W-2 is active, which is not only subject to income tax, but also to the payroll taxes. You get a W-2, you pay FICA and Medicare. So that's one of the tax advantages of investing in real estate is the income is passive. It's not subject to self-employment taxes. So a lot of what I was just going to build up to in terms of an effective tax strategy is, well, if I'm getting these big deductions and it's passive, but all I have is active income, then the quick answer to your question is that that loss will not offset your W-2 income unless we change our fact pattern. So the saying goes, if you want to change your tax, you have to change your facts. So we have to figure out a way to do one of two things. We either need to make your passive loss active, or we need to make your active income passive. Whatever direction, we've got to line those up so that they can offset each other. Clear as mud, or does that answer your question?
Yeah, that's helpful. Thank you.
Because Dallin makes a really good point. The tax points are really, they can get convoluted and very very complex. We try to keep it as simple as possible by saying, if you have passive loss, we either need to make that loss active so that it can offset the W-2, or we need to go the other direction and say we have active income. Maybe we own a business and we have business income. It would be difficult. Employees would not be able to make their income passive. But if you own a business and that's active trader business income, you can make that passive, and then your passive income from your business could be offset by the loss from depreciation, because then it's all passive. But we just have to make our income and loss align so that we can maximize the benefit of both.
And Beck, you own your own business, correct?
No, I do not. I get W-2 income.
Oh, okay.
So then what do we know about W-2 income? I'll tell you, we've got a lot of clients that are a married couple, and one spouse is a medical professional with a very high level of income. And then as part of a tax strategy, the other spouse is a real estate professional. And then we do what? We qualify as a real estate professional. Real estate professional then does exactly what we were just talking about. It takes your passive loss and it makes it active. So real estate professional enables you to take the passive losses that we talked about in the depreciation, make it active, so that if one spouse is a real estate professional, only one spouse has to qualify. The real estate professional spouse can have losses that offsets the other income earners, the other spouse's earned income. And that's been a beautiful, beautiful plan for years and years and years. Recently, I won't name names, but our friends in the government and in the White House said, well, it's not fair that happens. So they've made it so that there's an excess business loss limitation. And gosh, I forget the number. It's about 524,000, I think. We'll just say 500,000 roughly. What that means is if I have one spouse that has $1 million of earned income and another spouse with $1 million of passive loss in real estate that also is a real estate professional, they can only offset 500,000 of the earned income. So it gets to be pretty convoluted, the rules are, but generally speaking, we'd be able to offset that income and greatly reduce your tax.
I think that's where I'm headed. I think I'm going to make my wife is going to be on the active side of it.
You're gonna ask your wife back to be on the active side of it, right? Is that what you meant to say?
Do you know Tracy?
No, he just has a wife, so he knows how it works. So I'm glad my wife's not watching. But
Thank you.
So One thing I wanted to add though is, and kind of to your point, Beck, with the depreciation, it's become real popular, especially recently, I think, or I get a lot of questions regarding um, investing in real estate through your retirement accounts, and I hear it a lot. And in fact, I've had local investment firms come to the office and say, Justin, you do real estate. We need to connect with you because, and then they ask me, they say this like I didn't know any better. Did you know that your real estate clients can invest in real estate through their retirement accounts? And I have to tell them and I have to break their heart and say, yeah, I'm well aware of that. I'm not a fan. And here's why. Now, in saying this, I don't want to offend anyone. If you do it this way, then it works for you. Because the one thing I always say is, if even if I invest in real estate through my retirement account, all of the tax benefits that we just talked about are wasted. They don't apply to you. Because whether that property took a deduction for depreciation or it didn't, inside your retirement account, it's going to grow tax-free. So all the tax benefits of investing in real estate are wasted inside of a retirement account. So when you think of retirement accounts and real estate, I want you to think of this, and hopefully you can see this. Here's my retirement account. My retirement account is a tax shelter. Everything inside the retirement account grows tax-free, like your self-directed IRAs or 401ks or Roth IRAs, which is a whole other issue. And the real estate itself is also a tax shelter, just like we talked about. I can generate depreciation deduction that's non-cash. If that equals the cash that I generate from the property, then the deduction will offset the cash and I don't pay any taxes. It's a tax shelter. So if I put a tax shelter inside an other tax shelter, I'm going to have an unintended consequence. One day I'm going to pull that cash out of the retirement account, and guess what I'm going to do? I'm going to pay taxes, and I'm going to pay taxes on income that if I had done the same investment outside the retirement account, would not have ever paid taxes on, or could potentially not have paid any taxes on it ever. So I just wanted to be sure that you understood. And I know a lot of my clients that are doing syndications and they get real excited about their capital raises. Sometimes they'll even approach people and say, did you know you can do this through your retirement account? And they get real excited. And then they have to realize that, yeah, you can, but all of the tax benefits are wasted if you do that. So, and I'm not saying don't ever do it that way, because remember we talked about criteria in your investment strategy. If your criteria and investment strategy are to earn 18% or 20% or 30% rate of return on your investment, you can more likely do that in real estate than you can in the stock market, even if you don't get the tax benefits. But that's just something to consider as you move forward. So, and if I rained on anybody's parade, I apologize. Does anybody have any questions on that with the retirement accounts? Not a fan of that. It's not for tax purposes anyway. So, okay.
Justin, is that referring to both self-directed IRAs and like solo 401k or qualified retirement plans?
Yeah, absolutely. Because again, they're tax shelters, and the real estate is a tax shelter. If I structure the real estate deal correctly, especially in a multifamily syndication, especially my syndication clients, I'm always encouraging them to please do a cost segregation, accelerate that depreciation. That accelerated depreciation shelters the income. So then there's no taxes to pay. Well, that's for anybody who's outside the IRA or the 401k. If you made that investment inside the 401k or inside the IRA, it wouldn't matter if they took the deduction or not. You're not going to ever pay taxes on it until one day when you pull the cash out to live off of, with a required minimum distribution or just a regular withdrawal. That's when you'll pay taxes on it. And that's where I say, at that point, you'll pay taxes on income that had you not done that inside the IRA or 401k, you never would have paid taxes on, because it would have been sheltered. So it was growing tax-free anyway.
And a follow-up question to that, then we've got another great question here. If somebody's investing with their self-directed IRA because they don't qualify as a full-time real estate professional, so they can't fully maximize that depreciation, is that a different scenario, or would you still advise that they go a different route?
So I would still do it outside the IRA, or the retirement account, just to be brief and quick. I actually remember the last time that I'm presented to your group through this venue, talked about that specifically because I will never qualify as a real estate professional. I spend too much time in my practice as a CPA. But I still continue to invest in real estate outside the IRA or outside my retirement accounts. And I, not to be hypocritical, but I do have a 401k and I also have an IRA. I just don't invest in real estate through them because I want to maximize the tax benefits. So I'll give you an example. I'm a passive investor. I invest in a real estate syndication where they maximize depreciation through cost segregation. And all the people in the year one, they get their K1s and it shows all this loss on their K1. And everybody who's a real estate professional or qualifies for that deduction gets to take that deduction in full. But for those of us who are passive investors that do not qualify as real estate professional, we're not going to get to take that deduction that year. But, most of these syndications are a 3 to 5 year hold. Let's say in year 3, now they're going to sell that property. Well, that deduction I couldn't take in year 1, I can now take in year 3 or even year 5 or even year 10. I mean, you carry forward any unused loss in real estate for indefinitely, for as long as it takes. But when that property sells, any gain that was attributable to me or any gain that I get that was attributable to me will be offset by the losses I couldn't deduct in the first years. So I will never lose that loss, and it will offset the gain when the property sells. And that means when I get my share of the cash from that sale, that's tax-free to me. But it's tax-free to me in year 3 or 5, not in year 1, like it is for the real estate professional. So real estate professional helps you because it gives you that deduction up front. But if you're not a real estate professional, it's not the end of the world. You're still going to get that deduction. You're just not going to get it in year 1.
The only difference is when you could collect it. So the real estate professional is collecting it up front.
Yep.
Deducting it up front, correct? The non-real estate professional is collecting it later. So it's not like if you're a non-real estate professional, you don't lose that depreciation, just to clarify.
Correct.
You're just taking it at a different time.
It's just a timing game. You're exactly right. And so for that real estate professional that got the deduction in year 1, when that property sells, say in year 5, the passive investors like me, we get the deduction in year 5, good for us. The real estate professional, if they want to shelter that income from the gain on the sale in year 5 or the disposition, they better go find another investment to make so that they can generate a loss in that new investment to offset the gain from the old investment, if that makes any sense. So it's all just timing, but the benefit is still the same and it's not lost. So having said that, in answer to your question, I would still invest in real estate outside the IRA. In fact, I've met with many clients where we will take, someone will come to me and say, well, gosh, I got $1 million in a retirement account and that's all I've got to invest with, but I want to do real estate. So we've taken scenarios where we've done the math for them, calculated the tax, done the consulting and said, if you were to withdraw this cash now, here's your tax liability. And then that gives them marching orders then to go find an investment that will shelter that taxable income. You can't avoid the early withdrawal penalty. That's etched in stone. So that 10% is going to get hit no matter what. But the income tax can potentially be sheltered from whatever investment that you make. So the point is, what I'm trying to get at is we'll sit down with clients and say, if you withdrew that out of your retirement account, here's what you would need to do to shelter that income so that you wouldn't pay any taxes on it. You still pay the penalty, but you wouldn't pay any taxes on it.
So that was actually related to one of the questions by Anthony. Anthony, did that answer your question?
Yeah, it did. Perfect.
So it sounds like, based on Justin, on what you're saying, it's the question was, so would it be better to take the withdrawal and take the tax hit now rather than invest through your retirement account? And it sounds like it's more than just a quick yes or no. Like, you got to sit down, see what the tax implications would be, and formulate a plan around it. Is that correct?
Right. That's exactly right. Because the answer is always, it depends, right? Here's what it depends on. If Anthony, if you came to my office in December and said, man, I really want to get this out of my retirement account. Should I take it out now? I would say no, because if you take it out in December, you're paying taxes on it the following April, because you're going to get hit in that, it's going to get captured in that tax year. I would say wait 3 weeks and withdraw it in January. Because then if you withdraw it in January, you're not going to actually have to pay taxes on that until April of the next year. So now you've got 14, 15 months of use of that cash to invest with, to generate loss, to shelter the income, and then see what the tax implications would be. So that's the kind of thing that we'll sit down and talk about. Earlier in the year is better. Also, I would not withdraw it unless I knew exactly where I wanted to invest it. I would identify the investment and then make the withdrawal and go right into the investment. It's all about timing. And we do strategize with clients about that kind of stuff all the time.
Awesome.
That's a
Justin,
good
just so you
question,
know,
Anthony.
it was. And just so you know, we've got 8 minutes left. So I wasn't
Oh,
sure if
okay.
there was other things you wanted to touch on, or if there was other questions about this topic.
Yeah, let's just jump right to the end, because there are so many. I mentioned how much I just love real estate. There are so many tax saving opportunities in real estate. I know in this scenario or in this setting, we're talking mostly about multifamily housing, rental real estate. But when you factor in 1031 exchanges, there's tax saving opportunities there. When you factor in installment sales, there's tax saving strategies there. Low income housing tax credit if you're a developer, making improvements to your property for ADA. There's tax credits. There's all kinds of credits. These credits, and I always do this, and you guys probably even seen me do this before, and I'll just go back to it just quickly. But all of these credits are by design. I hear people complain about the loopholes all the time, and I always have to tell them these are not loopholes. Loopholes are unintended consequences. Loopholes are where the law was written and they didn't realize what would happen, and somebody found a way to kind of to take advantage of it in an unintended way. But what we're talking about with these credits and the depreciation and everything, that was specifically written that way to incentivize you to make these types of investments. It's not a loophole. That's the law. So I always tell the story, Donald Trump paid very little taxes. And then people would ask me, is that fair? And I would say, no, I don't think it's fair at all. He should pay zero, because if he's doing these things that he has the opportunity to do, and he's following the tax code as it's written, as it was intended to be followed, then that's his reward. That's anybody's reward. So I always refer to this, because this is Robert Kiyosaki's tax flow or cash flow quadrant: employee, self-employed or specialist, business owner, and investor. Everything that we just talked about as far as how to shelter the income through depreciation, that is definitely I quadrant type of investing. This is where you want to be. In fact, another way to look at this is, employees, they're going to be paying in the neighborhood of 40% on taxes if they're in the highest tax brackets. Self-employed, it gets worse, because now you're going to pay self-employment taxes, so it goes from 40 to 60. But as a business owner, and this is a big business owner, because certainly if you're self-employed and you have a handful of employees, you're also a business owner. But this refers to somebody who owns the business, but the business is not dependent upon them, so that if they didn't show up for work that day, the world will still turn around, and these people are still going to get their income. And the example of this is always like Berkshire Hathaway, the way he was able to do that. But when we're talking about the real estate investing and with the depreciation and the ability to shelter income, we're looking at I quadrant investing at 0%. The reason I bring this up is because the way you are taxed will depend largely on where you earned your income. If you're an employee, it's going to be taxed in these brackets, and ultimately the highest bracket here. I don't mean to say it will all be here, but self-employed individuals here, because they pay self-employment tax. That's in addition to income tax. So that's why it goes up higher. Business owners, if you're talking about long-term capital gains kind of stuff. Now we're into the 20%. And then if we're able to shelter all of our income, and what we were just talking about with one spouse as a real estate professional and the other spouse as a high wage earner, we can potentially offset most, if not all, of the tax. So I bring that up, but the one important thing I wanted to say is there's all these things that we can do in real estate that have tax benefits, like I talked about with these other avenues and credits and what have you. But if you're talking about permanent tax savings, as in no one will ever pay taxes on that, then the strategy that you need to look into kind of as a long-term strategy is to follow this strategy: buy, borrow, and then die. That's comforting, I know, to think that this is my strategy, is one day I'm going to die. But in short, because I know we're short on time, and if there's any questions, we can leave time for questions. But if I buy a property using other people's money, then we can do all the things that we just talked about, all the taxes that we could save. And when we talked about depreciation, the income that it generates by that property. As we're able to increase the value, if we can borrow against that equity rather than sell the property, this is good because borrowed funds are not taxable. So if I build up equity in that property, to say I put $200,000 into $1 million property, and a few years later it's worth 1.5 million, well, I can essentially do a cash out refinance and get my $200,000 back. Now I'm $0 into this property, and I didn't pay any tax on the cash I just got out of the property to go buy another property. Now for that same 200,000, I've got two properties, not just one. And what's more is if I get the cash out of my first property and I keep that property and it's generating positive cash flow and you know, you're getting a return on that investment, what's your percentage return on that investment? It's infinite, because you got $0 into that first deal, and then you took the money out and put it into the second deal for the same $2 for the same $200,000. Now I have two properties instead of one, and $0 in the first one. So if the first one's giving me any income, it's an infinite return. Ken McElroy talks about that a lot. But the die part is this: if I hold that property until the day I die, my heirs then, according to the law as it currently stands, and there are those who are opposed to it, but the way the law currently stands, if I own the property and then pass away and I pass that on to my heirs, they get 100% step up in basis. So, you know, this is why estate planning can be a huge part of your tax strategy. And we meet with clients on this a lot too. You know, don't give that gift to your heirs during your lifetime. Give it to them as a bequeathment, because if they inherit it, they get a step up in basis. They could sell that property at full market value the very next day and recognize all that gain and not pay any taxes on all that gain. So that's kind of the big picture strategy: buy, borrow, and die. We buy using other people's money, and we borrow because the cash that we get from borrowed funds is not taxable. We die because our heirs get a step up in basis, and then no one ever pays taxes on that property. It's a bit of a simplification, but that's how it works, and it does work, and it's fun to see. So anyway, I'll kind of leave it at that. There might be a whole bunch of questions after that kind of stuff, but that was the last point I wanted to make. I skipped over a bunch of stuff, and mostly because I was looking at the wrong page of notes to start out anyway. So thanks for bringing me back in, Dallin. I apologize for that. How embarrassing.
As you can tell, there's so much to this strategy, and it's not something that can just be learned overnight, and it's not something that you personally have to know all of it. Just connect with somebody that does. And as you continue to grow your investment portfolios and your net worth, you've got to build that team around you, a team of CPAs, attorneys, accountants, right? All these people to help you formulate this overall wealth plan, strategy plan. So real estate and apartments are our preferred vehicle to accomplish that. So we appreciate you all being here. Before we jump off, is there any questions that people might have? We all got to do some studying on the tax code and real estate. Listen, for those that are local to Arizona, we have one of our large real estate event tonight that we're putting on. Again, it's networking, it's education. We're not soliciting any deals. It's just more of what we do at Rev to give back and to help educate people. So if you are local to the Phoenix area, we'd love to have you there. It's a free event. There's going to be food, drinks will be available for purchase, but we just put that link in the chat box. So if you're local, we'd love to have you there. And if not, try to get you out to the next one. But with that being said, thank you all for taking time out of your days this morning. And we'll see you next week on the next Rev Real Estate Live. Thanks for tuning in.